When Insiders Sell Stock is the title of today's presentation, and we're going to look at just that. We're going to look at insider selling, a bit at insider buying, and talk about insider trading in general. So I wanted to start this conversation out with talking about time and the amount of time that you put into whatever it is that you do for a living, whatever job it is you're focused on. Usually there's a strong correlation between the amount of work you put in and the results that you get out. So you have to be very careful about calling people lucky, because the harder you work, the luckier you get. And people who achieve top positions in companies put in an incredible amount of work to get there. And then when they get to that top position, they spend a lot of time managing a company. It's not an easy task. This role isn't for everybody. So whilst people are very critical of what CEOs are paid and think they could do the job, one of the things that's required of that job is that you sacrifice most of your life to that job. And founders will tell you the very same thing. I can't remember the last time I put in a 40-hour week or worked 5 days a week. That's just the nature of starting a business. So they say that time is the scarcest resource leaders have. Where they allocate it matters a lot. Indeed, it does. So CEOs, this is based on a study by the Harvard Business Review, CEOs put in 9.7 hours per weekday on average, also conducting business on 79% of weekend days, where they spend 3.9 hours daily on average. You can top that off with several hours a day when they're on vacation. And then, of course, think about all the MDs and directors that sit under that CEO. They're putting in that same sort of time, highly likely. And then when these individuals decide to cash in on some shares and spend the money on something nice, they're berated by investors. So nobody said being a C-level person was easy. So when we talk about insider trading, we want to be very careful about the nomenclature here. So let's look at three terms here. Insider buying. That's what it says on the tin. So when company executives decide to buy shares of their stock, of course, that activity along with selling is highly restricted, but it's what it says on the tin. They're taking their money, they're investing it in the company that they work for based on the premise that shares of that company are at a decent valuation. Otherwise, why buy shares? Then there's insider selling, which is also what it says on the tin, but a bit more heavily regulated, because that's when they're taking money off the table. And then you have insider trading. So if you want to know why there's so much regulation around insiders buying or selling stock, it's to prevent the company from being on the front page of the Wall Street Journal because their executives were involved in insider trading. You don't leave that up to people's integrity. You put systems in place to prevent that from happening. So insider trading is illegal buying and or selling that skirts the processes in place that prevent such activities from happening. Of course, C-level people have tons of knowledge, so when they decide to buy or sell shares, that telegraphs something because they know more about what's going on in that company than anybody else, but they can't just do that willy-nilly. So my own experiences, I worked at a startup where I was compensated in options, and I also worked in a large publicly traded firm where every trading activity I did was heavily scrutinized along with everybody else. It wasn't just because I was at an officer level. So my brokerage accounts were linked to their systems. Think about that. So one of the things they did when I was hired is, we want a list of all your brokerage accounts and the companies that they're at and the account identifiers. Now think about that. You think I'm going to lie or keep something hidden? No executive is going to risk their job by not disclosing their brokerage accounts. And I had quite a few. I disclosed all of those. And they could see when there was a trade conducted in those accounts. And I had a number of violations of that policy, actually, unintentionally not paying attention. I would purchase a stock outside of a window and I would get a call from HR and I'd have to have a long conversation about how bad I was, and my hand slapped, and I can't recall what the penalty structure was, but at some point I think they would just lock you out of being able to do any trades. And I'm not talking about company stock. I'm just talking about any stock. And then, of course, we were allowed, I think, for ETFs and funds to trade those. Well, actually, there was restrictions around those as well because I worked for an index company and our clients were the largest passive managers in the world. So overall, this these limitations, I think, are a great thing to keep newbie investors in check, because if you can only trade during windows, and let's say those windows happen, I don't know, maybe every several months, then that keeps you from trying to time the market or jumping in and out of stocks, and it really makes you think about what you're investing in. So why do insiders sell company stock? So we're talking about people in a company, especially more senior level people, that are selling stock of the company that they work for, that they're holding. So according to a study conducted by a Finnish university, the most common reason, and this is intuitive, the common reason that an insider sells shares is because of diversification. So you think about that. If you're working for a company, all your income is coming from that source. You also don't want to have a lot of your wealth tied up in that source as well, because if things go pear-shaped, you not only lose your income, but you also lose your investment. So it's very common for executives who have a lot of their wealth tied up in the company that they work for to want to diversify some of that away. Other reasons would be tax planning, personal financial reasons, sending the kids to college, taking a distracted vacation, whatever. Now, companies know what share sales telegraph, so they're very particular about the rules that they set around sales, and in terms of company executives, and we'll talk about cluster trading in a minute, but company executives thinking through what messages they're sending to the market, in addition to rules that prevent insider trading. As I talked about, you have these normal insider trading windows. You see that there in the chart on the left, where it shows these fixed periods of time where insiders are allowed to buy or sell stock. That keeps people from manipulating the situation. On the right here, you see this common plan that you'll encounter called a 10b5-1. That's where you can set up a fixed period of time where you buy or sell a fixed number of shares, and similar to dollar cost averaging, it avoids market timing and avoids that problem. Here's an example, and some of you will recognize this individual's name, an example of a 10-5 that's being executed for an individual who holds quite a few shares. You can see these various columns. The first is that individual's name. Then you have the date. So you can see these are happening sequentially over the period of several months. The transaction's a sale, the cost at which the sale happened, the number of shares, that gives you the value. Then you see the total number of shares over time decreasing. In this particular case, this individual decreased their holdings by about 20%, which brings us to the point here. The biggest point when you're looking at insider selling is to put things in context. So what's the total sum of trades over a given period? So we looked in that example at several months. Well, we might want to extend that to several years. The amount of shares being sold relative to the total number of shares being held. In this case, this individual, who was the CEO of Ginkgo Bioworks, also a co-founder, dropped their holdings by about 20%. You want to pay close attention to what the most senior people in the company are doing when it comes to insider selling. You also need to consider the amount of shares-based compensation that they've received and have yet to receive. What's interesting about Mr. Kelly is in 2021, he received $369 million in shares-based compensation. And the sales that we looked at in that previous slide, those sales brought in about $6 million. So that's a drop in the bucket. Can you imagine seeing at that time all that money come in and say, wow, I have $369 million. Then you watch the share price crater and you're thinking to yourself, wow, I want to take some of this money off the table before it evaporates, right? So, and that's just what anybody would think. It says nothing about his perceptions of where this company is going. So his sales brought in $6 million. That's nothing compared to the total amount of value-based, share-based compensation that he received in 2021. Then you need to pay attention to things like cluster trading. A great example of that would be shares sold by a number of Exometry executives. This was taken from a short report on Exometry, and it's critical about the fact that these key individuals, you see co-founders, CFO, directors, CSO, COO, pay attention to the C's there. These individuals sold a lot of shares relative to what they're holding. You look at the first example of the co-founder there, Lawrence Zurif. He sold 32%. The CRO sold 72%. So they're selling a lot of their position all the way across the board, a cluster, as it were. And the short report pointed out that this is a bad thing. Now, we happen to, independent of this observation, exit Xometry for a variety of other reasons. But according to the individuals that did the analysis in that short report, that's a bad thing. And you can see why they would think that. But what takeaway from that in terms of how you address the position you're holding is up to each individual investor. It's just another input. Now, let's talk for a second about shares-based compensation. So compensating employees with equity is an effective way to align everyone's incentives. You have stock options. So the big difference here between stock options and stock is that you need to pony up some cash. So the startup I worked at, I had options granted over a period of 3 years at $1 a share. So if when those shares were valued at above $1, if I ponied up $1 a share, I could get the delta between what they were valued at and the $1 a share that I paid. So, and indeed, that was the case, though. When I ponied up the money, I didn't know the value of the shares because there was no exit event until there was, and when there was an exit event, the delta wasn't that great. But that's how stock options work. They're obviously more risky. You'll see those in startups. Then you have restricted stock units. These provide stock to employees using a vesting schedule, which encourages employee retention. They call these golden handcuffs because what will happen is they'll set up that vesting schedule, and then they'll give you another one the next year. So they keep extending out by 3 years, and you're sitting there saying, wow, I could have so much more money if I just waited another year, That's a golden handcuff, and it will keep you at firms. I've observed this myself in the company that I worked for. Individuals trying to exit found themselves always moving that exit date to the next year. Now, clearly, issuing shares to employees leads to dilution over time. We keep an eye on that by simply monitoring total shares outstanding. And recently, one of our analysts raised the question, well, what increases are acceptable year to year as a benchmark? Well, how long is a piece of string? That's really tough because you also need to look at why share count is increasing, because obviously firms issue shares to purchase other firms. There's other reasons why shares get issued. So you really need to dig in and do some analysis to examine that. Now, what you can do is look at SBC as a percent of revenue. So if you look at the average level of shares-based compensation in tech, it's increased quite a bit in the past couple years. So average SBC for tech rose from just 4.2% of revenue in 2012 to 10.5% in 2020, all the way to 22.5% in 2021. That's average. Now, studies have shown, or at least one study showed, that for a particular period of time, companies with the most conservative levels of shares-based compensation significantly outperform companies with the top 20% most aggressive levels of SBC. Now, what we can take away from this is that 22.5% of revenues for SBC is a benchmark. Now, if you look at C3, I recently noticed this in the piece we did the other day on C3, and you see here their total revenue on the top there highlighted, and then look at the bottom, total SBC over time as an expense compared to that revenue. Look at how dramatically that increases to where it's somewhere around 80% there on the far right, and it seems to be quite high. Now, this doesn't evaluate the increase in shares outstanding over time, but you could see here that being critical of the shares-based compensation for this firm would be appropriate. Now, the other thing that you need to realize here is that at least the last time I looked, C3 was one of the most difficult firms to get hired at least according to what they said in terms of selectivity. So if you're going to recruit the top talent anywhere, then you need to compensate them accordingly. Now, just to conclude, our view is that insider selling is oftentimes just extra noise, and the amount of effort that you go into analyzing it won't necessarily provide you with any sort of binary decision about what you ought to do with a stock. Now, some exceptions can be telling, like Xometry, but then what? You need to look at the much bigger picture before making a decision. Now, the way that we continue to go forward is that we'll measure SBC by the overall dilution. So how much are those shares being given away, affecting our share of the pie, we continue to believe insider selling is a signal that's not worth the time and effort to analyze because the results are usually inconclusive. Now, I've put up another video here that you might be interested in watching, but before you click that, please click the Nanalyze logo on the right, subscribe to our channel. Thanks so much for taking the time to watch this today.